What is going on, ladies and gentlemen? Back with another episode of reacting to the ICT mentorship with my thoughts, with my opinions, with everything. I hope you guys enjoy this series. If this video gets 200 likes, I'll keep doing them. So make sure to drop a like. It's free. And yeah, I'm not hating on ICT. I'm just watching these and reacting to them. And I'm giving my thoughts based on what I think and based off my experience after watching ICT. So hopefully I'm not getting any hate for this, because some people are like, oh, what I see, you're interpreting it wrong. Okay, I have literally watched price for 5 years, and if you watch price enough, you start to figure out your own things. So without further ado, let's get into the video. All right, we will be doing the intraday order flow and the daily range, which I don't really think I remember anything about this video, so let's get into it.
All right, folks, welcome back. This is the 2022 ICT Mentorship, and this lesson is going to be intraday order flow and understanding the daily range. All right, folks, we're looking at tradingview.com. These things that I'm teaching today are directly linked to index futures, okay, like S&P, NASDAQ, and the Dow, okay? You can use the Russell 2000. Those are the markets that I'm targeting with the lessons. All right, first things first, I'm going to get the boring stuff right out of the way. Whenever you're looking at futures, especially the index futures,
I mean, they work in everything, but index futures are just the best. Also, I've never tried the Russell. I mean, I think I've tried it once. It's all right, but NQ and ES are the best.
These contracts trade with expiration dates, and the months that they trade are going to be shown here. ES is the symbol for E-mini S&P. H in this example stands for March. So the delivery month codes for the commodity market, H is always representing the month of March. M is June, U is September, Z is December. These are the only 4 months that the index futures trade on E-mini S&P, E-mini NASDAQ, and E-mini Dow, okay? If you're pulling up the symbol, like I have here, ESH2022, that represents the E-mini S&P 500 contract for delivery month, March, year 2022. Since they expire, it's important for you to know that the third Friday of the month of delivery, which is obviously in this example here, March, the third Friday of that month is expiration. You do not want to be trading after expiration. And the question is going to be is, when do I start trading the next month out? Okay, this is always going to be the front month or the current month or nearby contract. The month after the front month or current contract month is always going to be referred to by me as the next month out. If you ever have a doubt, you can go to barchart.com and you can go to the select commodity tab here. This is all free. You can scrub down into this list here, go to S&P 500 E-mini, click on that. It'll open up what I just showed you there. And the first one, that's the cash. You don't want to look at that. The next contract available is March.
Dude, I feel like no unprofitable trader looks at this stuff. Like, if you're generally profitable, this is the stuff like you know about, but not a lot of the unprofitable traders know about. Like, this is like a whole extra step and tool that is very useful.
Right now, this is considered the front month or nearby contract. The open interest is what I'm watching. Okay, so 1 week before expiration, which is the third Friday of the delivery contract month. So third Friday of March, third Friday of June, third Friday of September, third Friday of December, roll over 1,300. Larger open. Take a look at the 15-minute time frame. All right, and when you're looking at this 15-minute time frame, this is the bellwether time frame. This is where I'm looking for key highs and lows. I'm looking for imbalances like fair value gaps and things of that nature. Yes, I'll look for order blocks, but I'm going to try to stay away from order blocks in this lesson, in this mentorship, really. But I want you to think about how you frame your day. I'm taking you to 8:30. Okay, you're going to put a vertical line there at 8:30. Click this, clone. I know this is very boring for some of you because you really want to just get in there and get to the nuts and bolts, but I have new people watching the same video, so I have to make this as complete as possible. All right, so what are we looking at? All right, so equal distance in time in the morning, then an hour lunch, New York lunch, and then an equal amount of time after that, okay? So I'm gonna zoom in here, and in your mind, I want you to think about that lunch hour, and this is always New York local time, okay? Set your trading view chart to this. If you do that, no matter where you are in the world, you'll be able to calibrate your local time with this. Everything I'm showing you is directly linked to New York local time. If you do it any other time frame, you're going to mess up. So once we have this, I want you to think of this hour here, noon to 1 o'clock in the afternoon, New York time. That is a no trade time period. So you have your daily range on it.
Okay, the lunchtime you can trade, but you need to learn how lunchtime works. Volume drops off during lunch for obvious reasons. how can I explain this? And the less volume, the worse ICT works, because things don't happen. Because it's my one friend always says some dude in their mom's basement and then across the world could sell a camel. You know, that's why you don't want to trade Asia, but it still works. It's a little more shaky, but you need to know how lunch works. And obviously, this is one of the starting episodes. Lunchtime, it's really good to see lunchtime run stops and then go the other way. You know, it's just like a general thing I see lunch do all the time. And he thinks, oh, if you're new, you're going to get manipulated here. You have to wait for the manipulation during lunch and then look for a setup. So he's obviously saying, oh, don't trade this. But as you get more experience, you can trade lunch. The one thing I will say is lunchtime is actually low-key good if the AM session sucks. So if AM session's slow and choppy, lunchtime will generally be good.
An intraday basis,
And by good, I mean like volatile.
All set up and laid out. So these are your boundaries. Your morning trade is between 8:30 in the morning. Why? Because there's news events that come out at 8:30 all the way to noon, preferably around 11 o'clock. All right, so we're looking at prior to 8:30. What are you looking for? What highs and lows are we looking for that, you know, a stop run would be framed on, or what would be the catalyst for a stop hunt? Well, prior to 8:30, if you look at that, and we see this high here, I want you to take a look at the high here and the low right here. So prior to 8:30, in other words, to the left of that.
Dude, that's like the easiest, like, oh my God, this is such a bullish wick, and we're reacting off this bullish right to the left, and we let the equal highs. Like, that was the easiest long ever.
On a 15-minute time frame, what's the most significant or obvious swing high and swing low? Swing high is this. It's a candle with a lower high to the left of it and a lower high to the right of it. 3-candle pattern, okay?
Notice how he says obvious. It has to be obvious. I always tell my students, if you're standing away 10 feet from the chart and you can see it, that's obvious.
It does not matter if the candles are up or down closes. You're just looking for a swing high, because above that's going to be buy side liquidity or buy stops, and a swing low prior to 8:30. That's a candle that has a higher low to the left and a higher low to the right of it. It's 3 candles. Again, it does not matter what the close of the candles are. It has absolutely no bearing on what I'm showing you here, because the swing points are where liquidity is going to be placed. So once you have these levels on your chart on a 15-minute time frame, then you can drop down into your first lower time frame for entry. That's your 5-minute chart. So let's do that now. All these things will be transposed right to the 5-minute chart. All right, so now we have this old high back here. Look at this price right there. Okay, that's going to be the high price. On that particular candle right there, it's 45.14 and a half. This candle trades to 45.14 and a half. Exactly the same high. But look closer. We have relative equal high, but we have it in multiple short-term highs that keep going higher. If there's 3 highs that go up like that, that's a classic 3 drives pattern. And that means it's a swing high, a higher swing high, and a higher swing high. So it's 3 times the market kept pressing up. I like to see this pattern forming when there's an old high back here, okay? On any time frame, it's universal. But if you ever start seeing these 3 drives up into an old high, you don't have to see that third high take out the old high, because what it's doing is it's already pressing into running out liquidity. Every time it creates a swing high and it starts to go down, bears are trying to sell that, and they're putting buy stops right above the previous high, and they keep getting taken. So it's already building in liquidity, and informed investors, or quote unquote smart money, will be already establishing short positions. Then the market breaks. In one of the previous videos, I talked about the pattern or the setup, and I suggested not using a particular swing low that looks like it's been violated. I want you to think about this idea that I teach, which is displacement. That's what you're looking for in price. When price goes above an old high and it trades down below it, you want to see an obvious displacement. You don't want to see it just do like, oh, well, you know, a little lethargic run here. That's not enough. This is like that elephant falling into that children's swimming pool. It's no doubt about it. It really had a displacement. When that...
Wow. Dude, all you need to watch to be profitable is the ICT 2022 mentorship, bro. Like, oh, wow. He's very good explanation. So he's kind of just saying, like, this, you need to see like that giant candle. It's like a death. I always call it a death candle. Like, it needs to look death. Like, it'll jump out of you. That's displacement.
Occurs, then you go in, you start looking for the fair value gap, the low, the high, and if it trades back up into that, then you can look for a short. So now we have this previous high, previous low. Now, if we did not, this is really important that you understand this part here. If we don't start seeing these higher highs forming and it's just one steady run up, then you anticipate a high like this to be taken out. And it doesn't need to be taken out by much. Just trade above it. And then you want to look for this energetic movement lower. That's displacement, where it's really animated. That's a little bit more pronounced because it went above this previous high here. Remember, 8:30, prior to that, you're looking for, what's this? It done a swing high? Yes. So it's trading above it here. Does it have an energetic break below that? No, it's just a very weak, anemic move lower. Then you have another
Exactly. Like if there's like a death candle below this low, then like, yeah, that's where you'd short. But there's never a death candle or anything, you know?
run higher here, and then you had this wick or tail come down, and it quickly snaps back. Does that create a fair value gap in that? No, it's not there yet. Then it goes higher here, doesn't go above, it matches that high. But then now this high, watch, does it go below that? Yes, a little bit here, but it's a little anemic still. But then look what we have here. It trades up.
Death candle.
Smashes down. Then the next candle here closes. What do we have? There's your fair value gap. That's your short. And you could reach for the liquidity resting below that low.
See, I never short this. I cannot short with equal highs above. That's the one thing. I've seen this short fail so many times. This is literally just a picture perfect example where it doesn't happen to fail. But man, I'm telling you, my favorite rule in this whole market is not shorting this because you will get wrecked at the time.
Identifying prior to 8:30. So sell side liquidity matching up with your short. You sell, you want to buy it back to cover that short. Well, here's waiting sellers right down here in the form of sell stops. Bam, hits it. Putting aside that you may not have seen this as a long entry, okay? Maybe you didn't see this as a potential continuation of bullishness. But look at these highs here. What's resting above that now? Buy stops, buy side liquidity. And then what do we have here right before lunch hour? It goes slightly above it and then trades down. And then we're in that time of the day, you don't trade.
Okay, I don't know what he's about to say, but this does not look like it actually. Like yes, it did run above it, but it doesn't look like stops were taken here. And I always tell people, like, yeah, we did go above it, but I didn't think we could go back and run stops, like, because I've just seen that. And that's like what a true stopper is. So I wonder what he says about this. I don't know. Let's see.
Trade it. New York lunch hour, noon to 1. Don't trade it. Okay, do not trade it. It can do a lot of weird things in that hour, or simply do nothing and go sideways. But either way, you don't want to be a participant in that because it's not usually a clean time of day for price action. So now here we have the high of the day and all the liquidity resting above here that would not have been tagged by this. In other words, stops that are resting a little bit above that. Because there's a lot of people trying to sell short. They want to see this thing go lower. But we created a very important low last week, and the market has already tanked a lot. So it's pulling back up in the run that it created going lower on a daily chart. So all these buy-side liquidity pools here are going to be a reason for the market to want to reach up to that. Because you don't have to be a participant down here as a buyer. You just need to know on the other side of lunch at 1 o'clock, start watching and see, is there an indication that this thing wants to go higher? And as you can see, all the buy side liquidity here ran aggressively here, but then the market
So it's run aggressively here. That really tells you, okay, now these guys are getting stopped out versus here. It doesn't really tell me that.
trades right into the close, aggressively bullish, small little retracement here, small little retracement here, and then immediate run right into the close. Now, obviously, the market trades a little bit beyond that, but this time of day, expect whatever algorithms that you would expect to be driving price and price runs to pretty much cap the majority of the volume that's going to be in that day. So what I want you to think about is how the day's designed to have a morning move, a lunch hour where you don't want to be trading, and then the afternoon move. Go back through your charts, and you can go back as far as you want. The more you do this, the better you'll get. But I want you to think about creating your charts like this and then describing what the morning trend was. Was it a bullish move? Was it a bearish move? Was it consolidation? If it was consolidation, prior to that part of the day, in other words, the previous day or the previous days, was it bullish or bearish then? Because if it was bullish, this is probably setting up another continuation higher, especially if you start seeing these relative equal highs forming, where it paints the idea that this is retail resistance. So traders are going to think that this is going to go lower, and it starts to build up a lot more interest in the form of buy-side liquidity or buying interest at a high price. Even though that those traders may be framing the context of their trades as a short entry, trying to make money going lower, their protective stop, if they choose to use one, is going to be in the form of a buy stop. And this is where it's going to be at. So the market's going to want to gravitate towards that, especially if you start seeing swing lows that are forming. Every candle has a higher low to the left and higher low to the right. If they start building up and every time they create a new one, it's going higher, that's a underpinning of the marketplace that's showing accumulation. It wants to go up because it wants to clean out all this here. Plus, we've been going up for a few days on the daily chart. Plus, the sentiment is everybody thinks it's been going down, so they all want to sell short because they want to see a stock market crash. But what they are failing to realize is we've already went down below an old low on the daily chart. So now we're running back the other direction, and anyone that's trying to sell short, unless it's a real quick intraday scalp, they're having their clocks cleaned. So in the afternoon, there's a trend, and one of the built-in characteristics.
So he's talking about the daily chart, how I think the daily before this month is dumped, and all he's saying is like so many people are like, oh, 5 red candles later, they think we're going to keep dumping, and that's what causes liquidity, and that's why we go back up. So that's why I always tell people on my stream, do not short if we just dumped 100 points. Wait, just wait, because you're going to get squeezed. Okay. I don't know when, but you're going to get wrecked at some point. It's very risky shorting low.
Characteristics of the afternoon is there's mechanisms that are built in that help this market really accelerate into the close. And if you study the price action in your lower time frame charts, you'll see that there's a repeating phenomenon that's typically around 20 minutes to 4 and 10 minutes to 4 and 4 o'clock. And it's all based on market on close orders. That's really what it is. Okay. And the algorithms will start spitting out really, really aggressive pricing and forcing traders to either cover or get out of their trades. And usually if it's going up, it really just ramps up and accelerates in that direction. So if you know what your daily bias is, and if you know what you're looking for in terms of range expansion on the daily chart, now what do I mean by that? The daily candle, do you expect it to trade higher or lower? You're not trying to predict, every single daily candle's close, but you're trying to determine, do you think that the daily candle you're looking at forming to.
And I've already said this, but if you're in the 1 minute time frame, you don't need to know what the daily candle is going to do. Don't do that. You're just going to mess yourself up if you try to guess what the daily candle is. I would rather go in the 1 minute and look for equal highs and equal lows like this to target than try to guess what the daily candle is going to do.
Today, or what would be forming tomorrow, is it more likely to be expanding higher or lower? If it's expanding higher in your analysis, that means you want to try to trade with the expectation to find a trade in the afternoon based on the logic that was used in the morning. And everything I'm showing you here is the same thing every day. Every single day, same thing. So back to the homework assignment. I want you to think about outlining what the session was in the morning and then what did the session do in the afternoon. Sometimes what you'll see is it'll be bullish in the morning and then reverse in the afternoon, or it'll be bullish in the morning and continuation higher in the afternoon, and you'll get like a measured move. What's a measured move? Whatever the morning move was, it'll duplicate that twice. So if it moves up 200 points in the morning, the afternoon could see another 200 points in addition to that and have a 400 point range. Or we could have consolidation in the morning session and then it trends in the afternoon higher or lower.
Yeah. Well, okay. So if we ever consolidate in the morning, typically the afternoon's good. And by good, I mean like it's volatile. And usually like we'll get like a nice inversion setup that's pretty nice at the end of the day, because like if the morning was crap, that's where you see the better plays in PM. But if the morning was good, then sometimes the PM will consolidate.
This day was bullish for you. Say you had the benefit of knowing that through analysis, you felt that this was going to go higher. This swing low here, first swing low of any importance after 1:30. This is really important. 1:30, I'm looking for swing highs and swing lows for the afternoon session. That's what I'm looking for. It's the same context that I use for the morning session. I'm looking for swing highs and swing lows prior to 8:30. I'm looking for the first one, okay? I'm not needing to go back days and days and days. I'm just looking for the first one. At 1:30, that's usually when I'm wanting to start trading the afternoon. That's the earliest. But I'm preferably looking for a swing high and swing low to form at 1:30. Why 1:30? Because there's an algorithm macro that starts running at 1:30. That creates movement at 1:30 in the New York session, okay, in equity market. So when that occurs, all we're looking for, or what I'm looking for, is a swing high and a swing low. And then that same basis of looking for a stop hunt in the morning, like we described here, I'm looking for the same thing here. That's it, same thing. So now think about this. I'm thinking that these stops are in jeopardy because it's too clean. The level's too clean. Straight line edges in the market, they don't tend to stay like that. There's going to be
this is what the books teach you. They teach you to short this. That's why this works.
Option. The market's been going higher, hasn't it? Yes. There's this pent up aggression that this market wants to go higher, but it's seeing short-term resistance here. It tried it a little bit here, and then retraced inside the lunch hour. The algorithm reserved the price run until later in the day. Now watch what happens. This swing low here gets violated right there. That small little stop hunt is all that's necessary. That will start what is called a buy program. A buy program is...
And sometimes that may not be all that's necessary. It just happened to be in this scenario. That's like the one thing, like you're like, oh, how do you know that was enough? Sometimes you don't know. You need a setup off of, sometimes you'll see a wick like this, we'll kind of wick up, but you won't get a model. That tells me, okay, that's not enough. But if we get this and go up and get a model, that tells me it's enough. So sometimes you just don't know until you get the model.
When the algorithms go into the process of spooling. Spooling is where it just continuously keeps offering higher prices. That's your signature. That's how you know that this is being completely manipulated. So if it's being manipulated, doesn't it stand profitable for you to know what it's likely to do? Not if you're going to know it all the time. You're not going to know. I don't know it all the time. But these things tend to repeat. And if they repeat a majority of the time, not every day, but the majority of the time, it's probably going to pan out. And then you can start doing long entries and then hold for the close. So inside this area, the market creates a swing low, runs through this low, stop hunt. So the stops below here are what? Sell stop. Buy those sell stops. It's the same thing that took place over here. Buy the sell stops that are resting below here and expect this level to be taken out. Consolidation through lunch after 1:30 in the afternoon, wait for a swing low to be violated, and then rally.
So that's a soup. He's saying buy these, if we go lower, but we also have buy stops above that we left, like equal highs, this can be a soup, meaning you can buy below this. And he teaches the entry model very nonchalant here, but probably this is literally the first entry model you could possibly enter. It's literally you can enter before an inverse, you can enter before a 2022 model. You can enter this entry model the first before everything, but it is the hardest for sure.
What if you don't get a swing low that trades below it? What do you look for? Well, you look for a move higher that's sudden, displacement higher, then look for a fair value gap. If it trades back down to the fair value gap, you buy that. There's your 2 patterns. That's it. It's the only 2 patterns you need.
So yeah, good video. It just, man, he's a good teacher, but he teaches some of it's like you can't watch the ICT mentorship and be like, yeah, dude, I don't even know what a candlestick is, but let me watch this. Like, you need to have some understanding in the market and how orders work and stuff. So, I don't know. That was a good video. Respect for sure. He teaches it well. He almost teaches it like how we know it, but like at the same time, he's showing us so many examples that like he's showing us examples in a way that we could go on our own chart and see exactly what he's talking about. And that's where I think the biggest learning is done. So, yeah, that's going to be it for this video. Don't forget to use code Dodgy. I think there's an 80% off right now for Apex if you use code Dodgy. 50K account, better than trading an actual live account, or else you're going to lose all your money. And yeah, it's like $40 for a $50,000 account. So go check that out. And I mean, yeah, earn that. I don't want to sound like a commercial, but if you got to the end, comment the word Bitcoin. Actually, no, don't do that. Don't do that. Comment the word, because then I'm gonna look like a crypto scammer. Comment the word magnet. Magnet. Okay, I'll see you guys later. Peace.